we have four conflicts with China. We have a trade war going on. We have a technology war going on. We have a geopolitical war going on. And then we could have a capital war going on. History suggests those things. So that dynamic has big economic and market implications and implications beyond that. For example, we're going from an environment in which we had globalization and interdependencies to an environment in which we have self-sufficiency necessary, because neither country knows necessarily where this is going to lead. And that means that you can't be cut off. History has shown that cutting off supply lines and all of that. So we're in that particular phase, and it's changing that way. There's a lot in common, and there's a lot to cooperate with. There's no doubt that China is a very effective force that will continue to grow. Since I started going there in 1984, its income, per capita income, real per capita income increased 22 times. It's become substantially larger in world trade than the United States, and so on. Its poverty rate's gone from 88% to 1%. So it's a force, and the interactions between that force are also going to have implications to capital flows, the effectiveness of the economies, and then the geopolitical issues. The most important, the investment environment going forward will be very different from the environment of the past. I mean, think about it as a zero and very low returning asset environment, because the liquidity that's in the market is driving the excess returns of all markets down to be low in relationship to the very low cash rate. So negative real returns, not good for cash and so on. The most important thing is to know how to diversify well. And what I mean by that is to go beyond just the traditional 60-40 stock bond mix, or even the same countries, and to broaden that diversification. To include in that portfolio assets that might seem unusual, to include some gold, to include inflation index bonds, to think about the currency exposure, to think about safety as different. Most people think that cash is safe. Cash is the least safe investment. It just doesn't have the same volatility to it, but it has, because they're producing so much cash, it has a negative real return. It's a tax that maybe 2% a year you lose money in terms of cash. So you have to think about risk differently, and you have to diversify best. That's the most important thing, to have a well-diversified portfolio. The uncertainties that we have today are so great in terms of all the things I mentioned, the tax policies, the geopolitical. Certainly we must experience it with the virus. Will the next wave come back, and how will it be there? Diversification can be achieved without reducing your expected returns because of the way that asset classes are priced. And then if you're going to take tactical bets from those, then those tactical bets, alpha on top of that strategic, well-diversified portfolio, should have highly diversified bets deviated. Liquidity is going to be more important than before because things change in unexpected ways. Look at how, in many of the cases, the businesses that one would have thought was a good business, and let's say you're in private equity, and that you're with that company. And so the restructuring, the ability to rebalance and diversify, and to be cautious about making a highly diversified set of bets is, I think, the future. But thinking even of asset classes, thinking about the value of money. We look at asset classes and we say, oh, do I want my money to be in stocks, and which stocks? But we don't think about stocks, bonds. We think about those traditional asset classes, but we don't think about the value of money and what's going to happen in terms of the printing of that value of the money and how to diversify it well. So I think those are the things that have to be paid attention to, in much as they were important things in years prior to 1945. When you look about when interest rates, let's say bonds, approach a zero expected return, clearly their ability to go up in value or interest rates to go down in value is limited, or in order to have the impact, one has to leverage those a lot, and that's not desirable. But clearly through history, and I studied the last 500 years of cycles, going back to the Dutch cycle in terms of the Bank of Amsterdam and that whole cycle. In all cases, central banks will print money and devalue money when they get in that course. The basic problem of a depression is basically a debt liquidity problem. And so always through history, the choice will be reflation, even when you hit interest rates in the way that we're seeing now. And so to understand that the nature of the diversifying asset has shifted to be of the sort that I'm describing in terms of other assets that at that particular time benefit from reflation, because it will be reflate or die. And so we will always see reflation. And that's why in history, you see that all currencies have devalued or died over a period of time, particularly in such periods. A bond or debt is a promise to receive currency. You're long the currency by being long in the bonds and so on. And so when debt is built up, and a lot of debt has been built up, but beyond debt, there's a lot of non-debt obligations, pension obligations, healthcare obligations, a lot of spending obligations. Those are like debt. And they all have to be met. And there won't be defaulting on that. It's politically unacceptable to default on pensioners and so on. So all of those obligations, insurance obligations, all of those liabilities are coming at us. And that then can be met increasingly by the printing of money. And so think about it, when you're holding a bond and it has no return and a negative real return, do you want to hold that asset? Who is going to hold that asset, particularly when there's so much printing of money? And that is the value, that is currency, that is cash. And so that issue, that risk, that there's a movement out of that is significant. So now we have to look at historical periods of when that were analogous to what's going on now. And that would, I think, be particularly the war years. The years when there are large deficits that are built up, there's the monetization. And so when we talk about yield curve control and interest rate controls and guidance, we're in a new world. I mean, think about it. It's so interesting. Where does the money come from? If you take Europe, for example, and you lend to banks at the central bank lends to banks at a -1%. And then, so they'll take that credit. Then they can decide when to roll it, or as they roll it forward. That means that there could literally be no debt service payments. So it is the means by which there's monetization and cash is being produced to deal with those liabilities. And that has an important implication in the value of cash, which is currency.